Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. The Chinese yuan devaluation has certainly put renewed pressure on Australia's resources sector and the economy as a whole. I caught up with Stephen Milch, Chief Economist at Suncorp Group, to find out exactly how big those ripple effects could be for the Australian economy. Stephen Milch, always a pleasure to catch up with you. Thank you so much for taking the time to chat with Dukascopy TV today.
Thanks, Natalie.
So, the Chinese yuan devaluation has certainly created fresh concerns for the Australian resources sector and really for the economy as a whole. How do you see this change really moving the goalposts or changing Australia's economic environment as you see it?
I think part of the answer, or at least to start the answer, we have to think about the motivation for the devaluation. Was it part of a bigger plan? And we did see, for instance, last month they changed the trading band for the currency. And so maybe the next natural progression was a mild devaluation, and it was mild, it was only 3%. That's kind of a benign interpretation of what they've done. The more sinister, I suppose, interpretation is that the economy is weaker than we all think. And some of the data for July certainly was weak. If that's the case, this is another attempt, and maybe an increasingly desperate, for want of a better term, attempt to get the economy going. Net, though, a depreciation for China should be a positive in the long run for Chinese growth. And what's positive for Chinese growth is positive for Australia through resources demand, of course. Back to that more sinister, I suppose, interpretation, that's what the market's become worried about in the last couple of weeks, that this is triggering a currency war, if you like, where the US dollar or the US economy is the last man standing, and that it's an admission, a veiled admission, that the Chinese economy is weaker than we all think. If that's the case, well, certainly the market has taken some interpretation along those lines, and that's impacted currencies, equities, commodity prices, and so forth. So long term, I think it's probably a mild positive. In the short term, it's a negative because it's caused nervousness.
Could it potentially impact Chinese investment into Australia, or will some assets, property, for example, we've seen as being, tremendously popular, could that kind of maintain almost sort of a safe haven status?
Let's get back to, again, the size of the devaluation. It was 3%. What would a 3% move of the Australian dollar look like? It would be about 1.5 cents. And we see that, fairly frequently. Probably every week we'd see a 1.5 cent move in the Aussie. So in terms of valuations and asset prices, it's not a big deal. So I don't think from that perspective it would encourage or discourage investment flows. But the other aspect, and then it gets back to the maybe the more negative themes here, is that if it leads to capital outflow from China. So let's say the currency is going to move further, the first 3%, maybe there's more to come. There are some fears out there, and we did see it in the Chinese market the other day, that there will be capital outflow. In other words, people getting out because their currency is depreciating. If that's the case, then Australia has been and will continue to be, a fairly attractive location for Chinese capital. So I think the Chinese capital story probably has a way to run, more as a structural or long-term theme than as a direct outcome of this devaluation. But there's a risk there that it does lead to extra capital coming out of China.
If we're looking then at the resources sector and the sort of potential impact this could have on that sector, how is this shaping your commodity price outlook?
Well, commodities, or certain commodities I should say, have been very weak, and only last night we saw yet another new low in the oil price. We've also seen it, for instance, in the copper price was quite weak overnight. Other prices, which are important to Australia, haven't been quite as bad. In fact, iron ore's been quite good over the last month. Chinese steel prices have been up a little bit, but generally the commodity theme has been weak. Now, looking forward, at the end of the day, it's supply and demand that determines commodity prices, and I'm not a supply expert. Certainly there's plenty of supply out there. But if our view, or my view, that the international economy is gradually improving and should continue to improve, we're seeing some growth in Japan, some growth in Europe, steady growth in the US. If that's the case and global growth is improving, then commodity demand should improve, and other things equal, that should at least see some stabilisation, if not maybe even a little bit of improvement in commodities.
Now, just lastly, I wanted to ask you about the Aussie dollar. We've seen this tracking sort of that yuan destabilisation and then a move back then to sort of comfortable territory very closely. How does this sort of shape again sort of what we could be expecting to see from the local currency?
The Aussie's obviously been very tied to Chinese fortunes for a long time now. And over the last couple of years, it's been a story of weakness. So China has slowed, commodity prices have come off, and we've gone from over parity to 73, 74 cents today. The interesting thing is, it's almost a paradox, that over the last month when this global currency gyrations have occurred from China, the Aussie actually has been relatively stable, which is very unusual. Again, we're in that 73, 74 kind of band. The market, the local market that seems to be copping the volatility is now the share market. But getting back to the outlook for the Aussie, I actually think we might have a little bit of excessive pessimism in the domestic economy and regarding China. You know, for instance, we saw Chinese property price data. That property market has clearly moved past the bottom now, and property is very important in China. So I think there might be a bit of excessive pessimism in there. The RBA seems to have stopped their jawboning of the currency, so they seem reasonably comfortable with where it is today. So with some of that pressure coming off and maybe some improved data coming through, I think we might actually gradually firm. That's not the consensus view, but I'm happy to be away from the consensus in this instance.
Striking away from the pack there, Stephen. Always a pleasure to receive your comments. Thank you so much.
Thanks again. Thank you.
Always a pleasure to catch up with Stephen Milch. I'll be back shortly with plenty more exclusive interviews for you right here from the heart of the APAC region. For now though, it's goodbye.